You probably already know SCHD. It's the dividend investor's favorite, the one that feels safe, steady, and built to last. But safety can be deceptive, because while SCHD protects your base, it might also be quietly capping your future growth. Behind its 3.5% yield and rock-solid reputation hides a blind spot. Entire sectors that fueled America's biggest market rallies are missing from your portfolio. So today, we'll fix that. We'll reveal the 4 ETFs that transform SCHD from a stable dividend machine into a complete long-term growth engine, without sacrificing consistency or peace of mind. SCHD has become more than just an ETF. For millions of investors, it represents safety, a place where money feels protected and productive at the same time. It's the comfort of quarterly dividends landing in your account like clockwork. It's the satisfaction of owning companies that survived decades, recessions, and rate hikes. With over $10 billion in assets and a track record of consistent growth, SCHD is now one of the most respected dividend ETFs in the world. Its low 0.06% expense ratio makes it incredibly efficient, and its dividend yield, hovering around 3.5%, continues to attract investors who prefer income they can actually see. That stability isn't an accident. SCHD carefully selects companies with a history of strong cash flow, solid balance sheets, and consistent dividend growth. It's a portfolio filled with American giants, names like PepsiCo, Coca-Cola, Home Depot, and Texas Instruments, businesses that make money in good times and bad. For long-term investors, that combination of quality and reliability feels like a fortress. It's the kind of ETF you can hold through storms without losing sleep. But here's the quiet truth behind that comfort. What makes SCHD stable is also what keeps it from accelerating. Because SCHD only includes companies that already pay strong, consistent dividends. That means it automatically excludes younger, faster-growing businesses that reinvest profits instead of paying them out. In other words, SCHD is excellent at preserving wealth, but not always at multiplying it. Over time, that trade-off compounds. While SCHD holds value stocks that protect your base, the rest of the market, especially technology and innovation, keeps racing ahead. It's like building a sturdy foundation for your financial house, but never adding the upper floors. Strong, yes, but incomplete. And that's where the story of this video begins. Not with what SCHD gives you, but with what it leaves out. When most investors look at SCHD's performance, they see stability and strength. But few realize that this same strength hides a structural weakness: concentration. At first glance, the portfolio looks diversified. There are dozens of companies across different sectors, and the top holdings seem familiar and safe. But look closer, and the illusion starts to fade. Nearly half of SCHD's weight is tied to just 3 sectors: financials, industrials, and consumer staples. Those sectors represent the backbone of the old economy: banks, manufacturers, and household brands. Reliable, yes, but slow-moving in a world where innovation drives growth. Technology, communication services, and healthcare. The sectors that powered most of the S&P 500's gains in recent years are barely represented. In fact, SCHD's exposure to tech is less than 10%. That's like driving through the modern economy with your rearview mirror. You're watching the past perform, not the future unfold. During market booms led by innovation, SCHD tends to lag. While companies like Nvidia, Microsoft, and Amazon soar, SCHD's dividend filters automatically exclude them. It's not because they're bad businesses. It's because they're too focused on growth, not payouts. The result is an ETF that wins in steady markets, but struggles when the world changes fast. It performs beautifully during recoveries and downturns, but misses much of the upside when technology leads the way. That's the invisible cost of concentration. It's not just missing one company, it's missing entire revolutions. From artificial intelligence to clean energy to cloud computing. These are the engines of modern wealth creation. And if your portfolio isn't connected to them, you're not just behind, you're stuck. Diversification isn't about owning more stocks, it's about owning different kinds of progress. And SCHD alone, for all its strengths, simply wasn't designed for that. Diversification is one of those ideas everyone agrees with, until they realize what it actually means. It's not just spreading money across funds, it's spreading opportunity across the future. Because the cost of staying too focused on one style, even one as solid as SCHD, doesn't show up right away. It compounds quietly, year after year. Take two portfolios starting with the same $10,000. One invests fully in SCHD. The other adds just one growth-oriented ETF to balance it out. After a decade, the difference may look small, maybe just 2 or 3% a year, but compound that over 20 or 30 years, and the gap becomes enormous. Tens of thousands of dollars in potential wealth never realized. That's the real cost of comfort. Not losing money, but losing momentum. SCHD's value stocks are like steady runners who keep pace mile after mile. Growth stocks, meanwhile, are sprinters who surge ahead when the wind changes. Without them, your race never accelerates. And it's not just about performance charts, it's about mindset. A portfolio too concentrated in one type of asset makes you dependent on a single story of success. One economic cycle, one set of winners. But economies evolve. Entire industries that were once unstoppable eventually fade. Just ask investors who built their wealth around oil, railroads, or retail. What worked perfectly in one decade can underperform in the next, and the market doesn't warn you when that shift begins. Diversification protects you from that blindness. It lets your portfolio adapt even when you don't have time to. Because building wealth isn't about guessing which stock or sector will win. It's about ensuring that no matter who wins, you're already in the race. If you're finding this breakdown helpful so far, make sure to hit like and subscribe. It really helps the channel grow. But more importantly, stay with me until the end, because in the next few minutes, we'll go beyond the basics of SCHD and reveal the 4 ETFs that can completely transform how your money grows. Most investors never connect these dots, and that's exactly why they stay stuck. By the end of this video, you'll understand how the wealthy build portfolios that work even when they're not watching. If SCHD is the foundation, then SCHG is the rocket booster. It's what turns stability into acceleration. SCHG, the Schwab US Large Cap Growth ETF, was built to capture the power of innovation. It holds the market's most dynamic companies, the ones rewriting the future in real time. We're talking about Apple, Microsoft, Nvidia, Amazon, and Meta. Businesses that rarely pay large dividends because they're busy fueling their own expansion. They reinvest profits into research, technology, and global scale. That's the energy SCHD lacks, not because it failed, but because it was never designed to chase growth. When you combine SCHD with SCHG, you're blending two different philosophies. One preserves wealth, the other multiplies it. SCHG has delivered strong long-term returns, averaging around double digits annually over the past decade. And while its dividend yield is minimal, less than 0.5%, its capital appreciation is where the real magic happens. Its top sectors are technology, communication services, and consumer discretionary, exactly the areas where SCHD is weakest. That makes them perfect complements. It's like adding an entirely new wing to your financial house, one that captures the sunlight of innovation instead of relying solely on the shade of stability. A 50-50 split between SCHD and SCHG has historically produced a smoother balance between income and growth. When dividends slow, growth kicks in. When growth cools, dividends cushion the fall. That balance matters more than timing the market, because no one knows when value will outperform growth. But you can own both and let time decide for you. SCHG reminds you that the best returns often come from the businesses you can't yet imagine living without, the ones still building the next decade while others cling to the last. And by pairing it with SCHD, you're not abandoning safety, you're upgrading it. Once you've paired SCHD's stability with SCHG's growth, there's still one gap left: total market exposure. That's where VOO comes in. VOO, the Vanguard S&P 500 ETF, is one of the simplest and most powerful tools ever created for investors. It tracks the 500 largest companies in America, the backbone of the U.S. economy. With just one fund, you own roughly 80% of the country's total market capitalization. It's like holding a micro version of the American economy inside your portfolio. The beauty of VOO isn't just in what it includes, but in what it balances. While SCHD leans toward dividend-paying value stocks and SCHG focuses on high-growth tech, VOO blends both. That mix provides an invisible stabilizer. a middle ground between defense and offense. When growth surges, VOO rises with it. When markets cool, its diversification cushions the impact. The overlap between VOO and SCHD is surprisingly small, is only about 7%. That means most of your VOO investment is adding fresh exposure, not duplicating what you already own. And because VOO's expense ratio is just 0.03%, it's nearly costless to hold. For every $10,000 invested, you pay just $3 a year. That's less than the price of a cup of coffee for access to the entire American market. Historically, a 50-50 blend between SCHD and VOO has outperformed either fund alone in both return and stability. It's the kind of combination that works across bull markets, bear markets, and everything in between. VOO isn't about chasing performance, it's about owning progress. It captures the story of American business in motion, from legacy industries to the tech leaders of tomorrow. And when you mix it with SCHD, you create a portfolio that's not only resilient but complete, because true diversification isn't about complexity, it's about balance. For some investors, growth alone isn't enough, because wealth that only exists on paper doesn't pay the bills. That's where JEPI, the JP Morgan Equity Premium Income ETF, changes the game. It's designed to generate real, consistent cash flow month after month. While most ETFs pay dividends quarterly, JEPI distributes income every single month. It's like turning your portfolio into a paycheck. With a dividend yield hovering around 7%, it produces one of the highest income streams among major ETFs. And it achieves that through a covered call strategy, a way of earning income by selling options on the stocks it already owns. In simple terms, JEPI rents out part of its upside to collect steady premiums. That trade-off limits explosive growth during bull markets, but provides smoother, more predictable returns through volatility. For retirees and income-focused investors, that stability is priceless. It means less stress, fewer surprises, and more control over monthly expenses. Imagine an investor holding $200,000 in JEPI. At current yields, that translates to roughly $1,100 to $1,200 per month, without selling a single share. That kind of dependable income can fund groceries, utilities, or even travel, while keeping your capital intact. JEPI's portfolio isn't reckless either. It includes over 100 large-cap names like Visa, Microsoft, and Progressive, spread across sectors from financials to technology. And with an expense ratio of 0.35%, it remains efficient given its active strategy. When paired with SCHD, JEPI becomes a powerful amplifier. SCHD provides quarterly dividends and long-term stability. JEPI turns that steady income into a consistent monthly rhythm. Together, they form the dual engine of reliability and cash flow, a combination that works even when the market doesn't. Because in the end, wealth isn't just about how much you have, it's about how freely it moves through your life. If SCHD gives you income today, DGRO is what makes that income grow tomorrow. It's the quiet engine that compounds in the background while you focus on living your life. DGRO, the iShares Core Dividend Growth ETF, follows a simple but powerful rule. It invests only in companies that increase their dividends year after year. That may sound boring, but it's one of the most effective wealth-building habits in the market, because behind every dividend increase lies something rare: discipline, profitability, and resilience. These are businesses that not only survive cycles, but thrive through them. Companies like Johnson & Johnson, JP Morgan Chase, ExxonMobil, and Apple, firms that raise payouts even when the economy wobbles. DGRO's yield, around 2%, may look modest compared to SCHD or JEPI, but its true power is in the growth rate. A company yielding 2% today but increasing that payout by 8% a year doubles your income in less than a decade. That's the compounding effect that most investors overlook. DGRO currently holds more than 400 companies, spreading your exposure across nearly every sector. It's less concentrated, more balanced, and remarkably efficient, with an expense ratio near 0.08%. When you combine DGRO with SCHD, something powerful happens. You create a dividend ladder. SCHD delivers strong income now, and DGRO builds a higher one for the future. It's the perfect harmony between present cash flow and future growth. Your portfolio doesn't just produce income, It raises its own salary every year. In a world obsessed with instant results, DGRO rewards patience. It's a reminder that time, not timing, is the greatest multiplier of wealth. Because anyone can earn dividends, but only a few let those dividends grow into freedom. Now that we've seen each piece on its own, it's time to put them together, because real investing isn't about picking favorites, it's about building systems that last. Think of your portfolio as a four-pillar structure. Each ETF represents one strength, and together they hold the weight of your financial future. SCHD is the foundation. It anchors everything with consistency, quality, and reliable income. It keeps you grounded when the market shakes. SCHG is your engine of acceleration. It injects growth and innovation into the mix, capturing the upside of progress. It's what keeps your wealth from standing still. VOO is your balance beam. It stretches your reach across the entire market, the safe, the risky, the fast, and the slow, creating harmony between all cycles. JEPI is your cash flow generator. It transforms your portfolio into a monthly income machine, giving you liquidity without selling assets. And DGRO, it's your time multiplier, the quiet gardener that waters your dividends year after year, turning today's small yields into tomorrow's steady streams. Together, they form a living ecosystem, a design where income, growth, stability, and compounding work side by side instead of competing for attention. This isn't about chasing what's hot, it's about combining what endures. Because when your portfolio covers all four dimensions of wealth, cash flow, growth, diversification, and time, it becomes anti-fragile. It doesn't just survive market cycles, it learns from them. And that's the difference between a collection of investments and a complete financial strategy. One reacts, the other evolves. Most people think diversification is a numbers game, but it's actually a mindset. Because behind every great portfolio is an investor who learned to let go of control, to stop predicting and start preparing. Owning SCHD, SCHG, VOO, JEPI, and DGRO isn't about having more funds. It's about having fewer worries. It's a framework that makes you calm when others panic. Diversification doesn't guarantee profits. What it guarantees is survival, the ability to stay in the game long enough for compounding to work. That's why the most successful investors aren't the ones who time the market perfectly. They're the ones who never had to. They built systems that protect them from their own emotions. They turned volatility into opportunity and patience into profit. Each of these ETFs represents a different way of thinking about money. SCHD is discipline. SCHG is ambition. VOO is balance. JEPI is practicality. DGRO is patience. Together, they don't just diversify your assets, they diversify your decisions. Because freedom doesn't come from making the right move every time. It comes from designing a system where even your wrong moves can't ruin you. The truth is, wealth isn't built by being fearless. It's built by being prepared. And diversification is preparation disguised as peace of mind. So while others chase the next big trade, your portfolio quietly works, earning, compounding, and adapting. Because real financial freedom isn't loud, it's quiet, predictable, and built by design. You've seen the blueprint, the foundation, the growth, the balance, the income, and the time. 5 layers of strategy. One system built for freedom. Because wealth isn't just about how much you make. It's about how intelligently your money is designed to work for you. SCHD, SCHG, VOO, JEPI, and DGRO. 5 different paths, one destination. A portfolio that grows, pays, and endures. So as you think about your own strategy, ask yourself this. Is your portfolio built on hope or on design? Every dollar you invest today is a worker you hire for your future. And the ones who show up every day through bull markets, recessions, and everything in between are the ones that set you free. If this video helped you see your investments differently, give it a like and subscribe for more stories that reveal how money really works and how to make it work for you. And if you want to go deeper, don't stop here. Click on one of the videos on your screen right now. Each one will take you further into the strategies, history, and mindset shifts that can change the way you build wealth. Not just this year, but for the rest of your life.